Good morning. Welcome to the B.F. Anderson Technical Report for August the 8th. Warren Buffett has a famous quote where he said, "You should be greedy when others are fearful and fearful when others are greedy." Excuse the noise. We have construction going on in our building. Anyway, the market has basically gone into a correction. We can clearly see this by looking at the NASDAQ daily graph. You can see the breakdown. It broke down, broke below the moving average. So the market is now in a correction. Now the problem with this is you really never know when the market is going into a bear market. And, bear markets start with corrections. But sometimes it's just a correction, consolidation, and then a resumption of the uptrend. For right now, that's the assumption we have to make because of our long-term indicators continue to look well. Now, if we look at the weekly graph, this is more of a intermediate term, long-term indicator. You can see here that we are holding above the 35-week moving average, and the 35-week moving average is moving up. Now, if we break below the 35-week and stay there for 2 consecutive weeks, that will be a negative connotation. Now, we also have to note here that last week, the volume was above average. The advanced decline line continues to struggle. We were actually resuming the uptrend. Then we got, last week, a lot of decliners versus advancers. However, the advanced decline line is continuing to flatten out. A little bit of improvement in the last couple of days. The high-low index, well, we're just getting a lot of new lows. You can see that it has been pulling back, and you'll note here that the new lows yesterday on the New York Stock Exchange were 227, which is pretty darn high. You can see we've really picked up on the new lows. We started to see this building, in July, and then it's really gotten above average new lows. Now, back at the end of last year, you can see what happened with the new lows. Not seeing that at this point. Now, on the long-term indicator, which is the 10-month versus the 20-month moving average, we're still in an uptrend. It's not like that there's been any kind of death cross. We're still in good shape there. Now, I want to talk today, the primary subject today is sentiment, because I'm finding this to be a real recurring incident where we get into greed, just like Buffett said, be fearful when others are greedy and greedy when others are fearful. Well, we have moved back into extreme fear. So what's happening is that the institutions are hedging their portfolios using puts and not buying very many calls. So this measure is just a way to try to measure extremes. When do we get extreme here? And when you get to extreme fear, that's usually where the market puts a bottom in. Now, if we look at the long-term, another long-term indicator, this is the 200-week moving average, very, very, very steady. We pull back and then we rally to new highs. Now, you can see the pullback we're getting, but it's well within the uptrend because you have a low here, higher low, and you still have a higher low, and you have a higher high. So we are in a correction. This does not look like a bear market at this time as of right now, but it is correcting. Now here's a kind of a frustrating graph for me. This is the Value Line Geometric Index. This really measures the average stock. This is just, 1,700 stocks. The index is not market cap weighted. It's equally weighted. And you can see here that we have just had the most difficult time getting any kind of rally going with these stocks. Now, if you go back to the 90s, 95 through 2000, what that really indicates to me is how easy the market became back then. Everybody was making money. It just seemed like every day the market went up. So when this index is having a tough time, it's just saying that investors are having a tough time. Now, on the global Dow, we're seeing the same kind of problem. The global stocks, the international stocks are just having a real difficult time getting going. And this is one of the things that have concerned the Fed is a global slowdown. Now, as we get into the discussion of sentiment, what I did here is I've developed a ratio. And the ratio is comparing the S&P 500 to the long-term Treasury bond. People, you have to realize that bonds are a fear asset. And so when the stock market gets difficult, people are going to run to bonds. They're going to run to puts. They're going to run to different asset classes. Well, bonds would be one of them. Well, you can see here on this ratio that when the line is going down, it means that bonds are outperforming stocks. So you can see here back in the drop that we had in December, actually September through December of last year, you can see how extreme that reading became. Well, we're in this correction right now, and we are really getting very, very close to an extreme reading. So, if you believe that sentiment is a good way to go, and I do believe that, this is a time you should be putting money in your portfolio, not necessarily doing aggressive buying, but you should be preparing to. Now, another fear asset is gold. So I did the same ratio. I took the S&P 500 and I compared it to the price of gold. Well, you can see here that when the line is going down, gold is doing better than stocks. So people run to gold when there's fear. So you can see here that we're really getting down to very close to extreme readings on this ratio. So just be aware of the fact that there's a lot of fear out there, and markets tend to bottom when there's fear. Now, one other comment one other issue we need to address is the yield curve. What I believe is driving this correction, and it really got started when the Federal Reserve cut interest rates 0.25%. Now, we thought that was going to cause a rally in the market, but because the Fed came out with language that said that they were only making a mid-cycle adjustment, so it basically caused the market to sell off because the market wants to see the Fed to continue to cut interest rates. I guess the market is telling us that the economy is slowing. Now, the yield curve has not inverted. This is the 2-year Treasury note versus the 10-year bond, and you can see that it's inverting, but not at zero. It's not like it's going into inversion. And there are actually studies out there that in the last, say, 40 years, there's been 2 inversions. I want to say one was in 1998, and the other one was 2005. And the market after the inversion rallied 30%. So this is not necessarily a bad thing. Now, as we get into the top 5, we're going to see something, a completely different group of stocks that are starting to lead this market. Again, this is Enphase Energy. This is a company that makes micro inverters for the solar industry. Now, I think what's going on here, and I'm pretty sure this is it, Huawei, which is China's largest electronics manufacturer, was competing with these companies here in the United States. Well, being that there's now a ban on Huawei, these companies basically don't have any competition. This company announced earnings back here with this spike in earnings. Their earnings were up 20-fold. Their sales were up 77%. So something's going on with solar. Now, this is Guardant Health. Again, you can see the big spike in volume. This is what you call a gap up buy signal. This company has developed a breakthrough technology where they're able to test for cancers using blood. This is Match Group, which is basically a dating service. Major earnings announcement, big gap up. Stock jumped 24% yesterday. This is Roku. Now, Roku announced earnings last night. The stock's going to rally. Came in with a real good number. And Roku is a pure play in the streaming media business. This is Shopify, which is a favorite of ours that we've owned in the past. We don't own it right now. But you can really see just a really beautiful trend, very solid. This is a potential competition to Amazon. This is e-commerce. So all in all, what I'm saying is, yes, we are in a correction. Is it going to get worse? It could. But with the sentiment readings right now, reading these extreme levels, I'd be more inclined to either sit tight, maybe do a little bit of buying, don't get too aggressive, but this is where the window of opportunity opens, not really closes, it opens. Thank you very much.